All right, let's talk about CoreWeave's latest earnings report because, wow, it is a wild one. It's created this huge dilemma for investors, one that pits just insane, explosive demand against some really serious risks. Let's get right into it.
So right at the center of all of this is this massive contradiction. On one hand, the company missed its revenue guidance, and for investors, that's usually a huge red flag. But at the exact same time, they added a mind-blowing $25 billion to their order backlog. So the question for us is pretty simple. Is this just a temporary hiccup on the road to greatness, or is it a sign of some much deeper, much more dangerous problems?
To figure that out, let's start with the bull case, because the story here around the demand for what CoreWeave does, well, it isn't just strong, it's almost hard to believe.
Let's just start with the big number. CoreWeave's total order backlog is now sitting at over $55 billion. Look, for any company that's a massive figure. But for a company that's still pretty new in this space, that is an incredibly powerful signal about all the revenue that's coming down the pipeline.
And it's not just the size of that backlog, it's the speed. I mean, the sheer velocity of its growth. It didn't just grow, it absolutely exploded, up 85% in a single quarter. It almost doubled from Q2. This isn't just growth, it's like hitting the afterburners.
And to put that growth into perspective, management pointed out this absolutely stunning fact. They hit $50 billion in RPO, which is basically just a fancy term for contracted future revenue, faster than any cloud provider in history. Think about that. They're outpacing the literal giants of the industry. It just hammers home how completely unprecedented the demand for their AI infrastructure really is.
Now, if you're an investor and you're worried about risk, this slide is absolutely crucial. A big knock on CoreWeave earlier this year was that they were way too dependent on just one single customer. Well, they have been aggressively fixing that. That top customer went from making up 85% of their backlog all the way down to just 35%. That massively de-risks the company's future.
And who's filling that gap? Oh, just some of the biggest names in tech. We're talking multi-billion-dollar deals with Meta, a huge expansion with OpenAI, a new order from their key partner NVIDIA, and they're even breaking into the US federal market. These are not speculative deals. These are blue-chip leaders, and they add a ton of credibility to that $55 billion backlog.
Okay, so you've got this avalanche of new business from the best customers on the planet. So how on earth did they miss their revenue target? Well, the answer comes down to a major bottleneck that is starting to affect this entire industry. The reason management gave for the miss, for the delay, boils down to two words: powered shell. So what in the world is that, and why does it matter so much?
Think of it like this. You're building a new house. Before you can move in all your furniture, and in this case, the furniture is the super powerful GPUs, you need the house itself to be finished, right? You need the walls up, the electricity on, the plumbing working. That's the powered shell. And if that shell isn't ready, all those expensive servers just sit in a warehouse and you can't book any revenue from them. That is exactly what happened to CoreWeave.
And hey, don't just take my word for it. This is a critical piece of context right from the CEO on the earnings call. He basically told investors to get used to this problem, not just for CoreWeave, but for the whole AI space. The bottleneck isn't a lack of demand, it isn't even a lack of chips, it's getting the physical buildings ready to put them in.
And understanding that bottleneck is so important because it leads us directly into the bear case. You see, building these data centers at a record-breaking speed comes with an equally record-breaking price tag, and that introduces some serious financial risk.
Let's start with the debt. CoreWeave is carrying $14 billion in debt on its balance sheet. They are borrowing, and borrowing aggressively, to fund this huge expansion and get that capacity built before the demand even fully arrives.
And while they're taking on all that debt, this is what their cash flow looks like. In just Q3, they burned through $1.6 billion. This is the price of growth. You're spending massive amounts of cash on new buildings and equipment long before that investment starts making you any money.
Now for some really important context here. A key way to measure a company's financial health is its debt-to-EBITDA ratio. Basically, how much it owes versus how much it earns. CoreWeave's is sitting somewhere between 5 and 6x. Now, compare that to a mature, cash-rich company like NVIDIA, whose ratio is a tiny 0.1x. This contrast just paints a crystal-clear picture of the high-leverage, high-risk path CoreWeave is on right now.
And this pressure isn't going away anytime soon. The company is straight up telling investors that their margins are going to shrink in the short term. Why? Because all the costs of building these new data centers hit their financial statements right away, but the revenue from them only trickles in later.
It's the classic short-term pain for long-term gain, but that pain is very, very real.
So you've got this incredible historic demand on one side and this high-debt, cash-burning expansion on the other. How is an investor supposed to make sense of all this? Well, it all comes down to understanding which phase of life the company is in.
You can really think about it in two phases. Right now, CoreWeave is unapologetically in the build phase. This is the land of hypergrowth, but it's fueled by high debt, and it means you're burning through cash. The whole goal is to survive this phase long enough to get to the yield phase. That's where growth slows down, you start paying off the debt, and the business finally starts spitting out huge amounts of cash.
So here's the bottom line. An investment in CoreWeave today is not a bet on their current earnings. It's a bet on their execution. It's a bet that they can manage these powered shell bottlenecks, navigate this high-debt world, and make that incredibly difficult transition from just building capacity to actually making money off of it.
At the end of the day, the company is betting billions of dollars on itself. They believe this unprecedented demand justifies the enormous risk of this build-out phase. The question for every single investor is pretty simple. Given the very clear risks and the monumental potential reward, are you willing to make that same bet?